My name's Lance Lambert. I'm the founder of ResiClub. We are a news and research outlet that covers the U.S. housing market. And today we have Sean Dobson, the CEO of Amherst. They are one of the largest operators in the single-family rental space. Sean, thank you for coming.
Thanks for having me.
And when you look out at the housing market right now, there's, very low levels of transactions. Existing home sales on a population adjusted basis are at, 30, 40-year lows.
Right.
Home prices, kind of flattish, but, there's big chunks of the South where they're down a bit, right?
Sure.
After, a decade-long run for a bull market for prices. And so with the housing market where it is, what is kind of like your view of this housing market?
Well, thanks again for having me. It's tricky, right? Because there are times when we thought the housing market was just obviously overvalued and it only had one way to go. And there are times when we thought the housing market was obviously undervalued and only had one direction to go. Here, it's way more technical, right? I would say that housing is in a transition phase that's affected not only by the changes that came about post-GFC from access to credit, but on the actual use of the asset. So it took us a while to figure this out because we're in other businesses. We have a lending business in commercial real estate, but the use case of the home has changed. We were just talking about New York City. The pattern really for New York office workers is 3 days a week in the office, which means that there's 2 more days at home. That means that the usage of the home doubled. So all the metrics we use to figure out on where a home should trade relative to median income and interest rates, the skew of the home buying population versus the overall population, almost none of those metrics work when we realize that the utility of the detached house or of the residence has doubled. And just in the Manhattan area, in other cities, office work is down even more than that. So I think we're in a market where we're trying to figure it out. Like, what are the new metrics? If the old affordability math doesn't work, what are the new metrics? But I can say that on just a flow basis, we are seeing the market is what we call trading heavy. Like, prices are hard to maintain in general, and it's just because of the simple math of the people that can buy, that need to buy, have a real affordability hurdle. Home prices we think would be lower if there were more sellers, obviously, but there's good reason there aren't more sellers, right? So many people got such low interest rate mortgages that at a time when the demand would naturally fall from rising interest rates also cause the supply to fall. So I would say we don't do like near term. When we buy into this market, we buy on a 10 or 15 year basis. It was easier to buy in 2010 than it is in 2025. But we're really not worried about meeting our return objectives at today's home prices over time.
So when you look at some of the markets that have really boomed, considerably over the past 5-10 years, the Floridas, the Texas, you go into Austin, look at San Antonio, Tampa, Jacksonville. Today, those are kind of some of the weaker markets, right?
Sure.
They're kind of softer. Do you think they're just kind of going through a recalibration period? And how long does that look like?
Yeah.
And what do you think is contributing to it? Do you think it's like the net domestic migration shock, like they're not seeing as many people move in as during COVID, and maybe prices went up a little too much too quickly? Yep. And then they also have more of that new construction supply that's kind of softened those markets. Yeah,
I would say that what's the common theme amongst the markets that are retracing. So Austin, you mentioned Jacksonville's is not quite as bad. Western Florida, the Tampa Bay area, Cape Coral has been really tough. I would say the common theme is those are places that's pretty easy to build. And as home prices moved above kind of their construction costs, they naturally kind of tend back down. And so those places, the market did what the market's supposed to do, right? Prices were rising and rising quickly, and home builders came in and they built a lot of supply. Even in a place like Dallas, so we try to because we're like you, we're in the housing market all day, every day. So we don't really do that much work on like the U.S. housing market. Mm-hmm. We do work on much smaller micro footprints. But if you take a place like Dallas, right? Dallas overall seems like it's okay, healthy, not great, not weak, okay, healthy. But if you bifurcate the homes by vintage year and look at their price movements, then Dallas looks a lot like Cape Coral, right? The new home construction market in Dallas looks a lot like Cape Coral. So builders came at they did, getting land permitted getting lots platted, getting horizontals in, all takes time. So there's always a lag between when the housing market really wants to buy the homes and when builders can deliver them. And that oftentimes creates too much supply trying to squeeze through a channel that only has a, kind of a waning demand, I would say.
And so your rental side is less of the build to rent product, and it's more of, scatter site,
That's right.
Single family rentals. Yep. Has that been helpful for your business versus like some of the build to rent, where some of that product is in those areas in Dallas where there is a lot of the new construction?
I would say so. We did a lot. We built a lot of homes, and people don't really know it, but in 2020, 18, 19, we were for some builders, we were a fifth of their flow, right? So we bought a lot of homes, a lot of new built homes. We did build some full communities. The one thing we didn't do is we didn't do the single plat products. So what I call the horizontal apartment complex. And those have been pretty successful, and they're pretty cool product. We couldn't figure out how to underwrite them because they were kind of new. They were hard to benchmark. But yeah, I think we've probably had a little bit less of difficulty because we own more scattered sites, and scattered sites has operating disadvantages, but it has real investment advantages because of the geographic dispersion. The stuff that we've seen when we underwrote a lot of the deals that were getting done, you kind of had to take rents from 10 miles away or 5 miles away and sort of assume that you would get those same rents. And, like housing is very personal, very specific. It's the drive to the school, the drive to the grocery store, the drive to work. And even if you're working from home, there's still school and there's still groceries. So a lot of these places are in kind of this emerging front edge of economies. And we just found it very difficult to underwrite.
And so how would you compare and contrast, and really the contrast, having lived both of the past boom cycles, this pandemic housing boom versus the 03, 04, 05 cycle?
Yeah, I think this one, I would say the two differences are the sustainability of the economics, right? We got too good at underwriting mortgages post-2008. The reason our business exists is because it's too hard to get a mortgage. The flip side of that is it's very unlikely that you have. So I would say, first of all, the things that drove home prices kind of well above what we thought were sustainable levels in 2005, 2006 was tricky financing, right? Leverage, teaser payments, people that couldn't, the mortgage wasn't sustainable based on their underwritten incomes and things. And then that was feeding itself into higher buying power and feeding itself into excess demand where people were buying 3, 4, 5, 6 homes for rentals. I would say that the post-COVID, it's this fundamental use case that's changing demand, and the finances are very sustainable. So even though that we think that on average home prices are hard to explain relative to historical metrics of affordability, we don't see and haven't found, although we're always on the lookout for that catalyst that's going to say, oh, well, the markets are going to got to correct to historical affordability metrics because the mortgages are so well underwritten.
In last cycle, well, 2 cycles ago, how did you spot that catalyst, and how did you allocate capital at the time?
It was I could talk about this for days. It was like you do one good trade, you spend the rest of your life talking about it. But what we figured out, a couple things was we built a credit model to anticipate credit risk in mortgages, price credit risk in mortgages.
And what year was this?
This is in 2003 we built it. And we built it completely out of a defensive measure because at the time we had an enormous business, like a big business, $500 billion, $600 billion a year trading platform in mortgage-backed securities. The vast majority were agency guarantee mortgages. So we really didn't have to think too much about the credit risk in the loans. They turned out to be prepayments, right? But if you sort of zoom back in time, what was happening is that the securitization market was taking more and more credit risk. So more mortgages were being originated to be securitized without Freddie Mac and Fannie Mae or FHA insurance. So the capital markets were taking the credit risk. We said, okay, well, this is underwriting consumer behavior and how that behavior changes when the economic environment around the consumer changes. That's how you model prepayments. So we're like, we've seen this problem before. Let's just stop what we're doing here for a couple of days and build a credit model. Well, the good thing for us is we didn't know anything about credit modeling. So we built a model that was completely differently organized than historical credit pricing models. Historically, credit models were priced on sort of actuarial basis. So a FICO score, an LTV, historically would be regressed to say, well, this is how many defaults you have, because you always have defaults. The default rate's never zero. What we said was like, well, that might be the case so long as home prices are constant or constantly rising. But what happens when home prices go down? When interest rates go down, everyone gets the joke that homeowners will prepay their mortgage. The question was, if home prices went down, would people default? And we thought that the default probability of a loan was going to be dependent upon home prices. And as far as I know, we may still have the only model that looks at the world that way. When you took the loans to go calibrate a model like that, you have to go find periods of time where home prices went down and then see how performance changed and correlate basically mark-to-market LTV to default risk. And we found a bunch of data that allowed us to take really what wasn't that well studied. It was the Farm Belt crisis, where you had about 50 million loans that you could, or not 50 million loans, you had about $50 billion worth of loans.
And what year was that?
The Farm Belt crisis, this is where Willie Nelson's Farm Aid came from. This probably was 85, 86, I'm guessing.
Okay. So is it like the Texas bust?
It was really kind of the heartland. It was like northern Texas up through Kansas and kind of the plains. It was where the big agribusinesses are. But there were a lot of residential real estate there, and you had an economic recess, a big recession that was hit in this agribusinesses. So we basically were able to take how their home prices changed and correlate it to their change in behavior, their payments. This is kind of controversial because people don't want to think that a consumer is sort of so surgical that they're like, my LTV is too high, I quit. It might not be that surgical, but it's highly correlated. Yeah. Right? It may be other things that you're detecting.
But there's some type of threshold there.
Yeah. So, and the thing that we caught that I think looking back that was probably more important than even we understood it is that threshold exists no matter what your FICO score is. So you can think about the FICO score as an asset, and that asset can be valued by your difference in cost of capital. So if you have a 500 FICO score, you may have no access to capital or really expensive capital. If you have an 800 FICO score, you have a lot of access to capital and very low. Well, that can be measured and just valued. And if you measure that value of that FICO score, then say, okay, what's it going to cost me to lose it by defaulting? Well, if you have a loan that you owe $400,000 in a $200,000 house, there's a $200,000 gain for defaulting. And that $200,000 may be worth more than your FICO score. So we built this whole model on kind of like a theoretic of if everyone was just completely rational, how would they behave? And then we tested it against their actual behavior. And it's not just like mortgage prepayments. It's not one for one, but it's very directional. And so that when we sort of got this model calibrated, it just so happened we were building the model actually to find previously issued mortgages where the homes had appreciated a lot, but the mortgages were still trading as if they had a lot of credit risk. So you could, an 80 LTV loan that had become a 40 LTV loan, could you still buy it as if it was an 80 LTV loan?
Yeah.
And what we found was that we found two things. We found that there was a way more beta in credit risk than people thought, right? And then we found that there was a scads of loans that you couldn't calibrate because the combination of risk factors available in those loans had never been available to the consumer. So it wasn't the fact that you made someone a loan if they had a low FICO score. That had been done. It really wasn't an issue if you made someone a loan with limited amount of research on them at the time that they had borrowed the loan, because that had been done before too. When you did both those things, right? It wasn't unusual to give someone a first lien and a second lien if they also had a high FICO score. But what happens when you give them a first lien and a second lien and they have a medium FICO score and you don't fully validate their income? It was those layered risks that now everyone sort of knows are the joke. At the time, no one had kind of tried to intertwine and say, how did these different risk factors all change that correlation of behavior to home prices?
And so with that information and that theory, what was the bet that you made? And then how is that bet compared to like the Big Short bet? It
wasn't a big enough bet, I can tell you that. So what we did was we didn't know what was going to happen, right? In our business, and most of our investors are really long-term, really large investors. They're not like in a trade. This is why I really can't answer a lot of questions about what's housing going to do this year or next year, because it kind of doesn't matter. These investors are 5, 10, 15-year cyclical investors. And so what we said was we don't know what's going to happen. What we said was the risk premium in these securities is wrong, right? It just means you're buying a loan that you don't know how it's going to perform, and you're being paid a little extra return for this loan, but there's a low probability that return is enough. So it wasn't that we said we know what's going to happen next week. What we said was that effectively investors are taking a very low risk premium for a very high risk. So when that happens and you're in the scale investing business, you say, okay, well, if I can basically, I can go take risks I understand, and I can hedge those by getting short the risks that I don't understand, right? Or that maybe the market has mispriced. And so that was most of the trades. They were basis trades. They were relative value trades. They weren't like, we know on October the 15th, there's this many loans are going to default. It was like, these things are just mispriced. And they may work out just fine, but the return just wasn't worth the risk.
And how long were you making that bet?
Oh, we were handing out, I always like to tell the story. We handed out hard hats at a convention for mortgage nerds in 2005 that said, beware of falling home prices. And so this is in the winter of 2005. So we were started basically trying to shed the risk. And I would say, publish the fact that we thought the bonds were radically mispriced in late 2005.
Yeah. And prices peaked then like mid 2006.
Yeah, we lost a lot of money. We lost a lot of money in 2006. And then I would say mortgage securities pricing didn't peak until late 2006 or late 2007. Yeah. But I would say from a trading perspective, like from a research perspective of like, was there a problem? It was really the first quarter of 2006 when it was all over.
Yeah. And so then around 12, 11, when the market had bottomed, that's when you at Amherst started to buy some single family rentals.
Yeah, we started buying in 2009. So we had a meeting with all of our partners, and we were pretty tired, really. I'm not tired, but exhausted from this roller coaster, right? So we set these trades up thinking that you bought a security that should yield 8 and you bought it at a 9, and then you sold a security that you thought should yield 7 and you're paying 4. So you're thinking you're going to make a spread there. Well, then, everything blew up, and the bonds that we were short were going to zero, and the bonds were long were doing fine. And so the trade got crazy. And then there was a moment in time where trust was lost in the system, and people didn't know you. So if the rating didn't matter, and if you were an investor that was employing leverage, and you had a mortgage-backed security, the lenders were like, I'm not lending you, I'm not financing that position for you because I don't trust the ratings anymore. So then it got just wild, and that's when the price swings. That's when there were prices that were way too low, and there was volatility, and that's when Lehman went down, that's when Bear went down. So we spent a huge amount of time on those things, like helping people try to buy Bear, try to buy Lehman, and helping people try to hedge their way around it. But by 2009, we were sort of, things had kind of settled down for us. We kind of had a view of what was going on, and we're looking around as a financial services platform. Remember, we sort of have two things we do every day. One is we guide our investors in how to make returns that we think outpace inflation, out their cost of capital. But then as a business, we have to figure out where are those investors going to need services 5 years and 10 years, and how do we get in front of that and build those capabilities out? So you're always trying to increase the quality of the services you deliver, like any business. So in this business strategy meeting in 2009, we're like, well, okay, well, what's going to happen next? And there were discussions about, well, should we go buy all the subprime mortgage originators because you could buy them for nothing? And, they used to be really good businesses. And we looked at it and we made a couple of, at the time, bold statements, right? Which was the subprime mortgage market's never going back, right? People lost $1 trillion or $2 trillion, whatever it was. And capital markets have a long memory. Regulators have a long memories. Lawmakers have long memories. So you don't want to be the guy that's out there trying to sell the new and improved subprime mortgage. But we sat and reflected on it, and we said, okay, well, there are millions of families that were succeeding in subprime mortgages, right? And the history of the subprime mortgage business is actually very good. Like what I like to say is, even in the dumbest pools where you just closed your eyes and you threw money out the window hoping someone would pay it back, about 2/3 of the people paid the money back, right? So most of the time, 90% of subprime loans worked. So we're like, we know that the houses are there, and we know that the people are there. What's missing is their access to long-term financing, and that just means one thing: it means they're going to rent. So then so in 2009 we started buying homes, and we started buying homes on our own balance sheet, and it took us until, I would say, 2012 to be willing to expose third-party capital to the investment, because that gave us time to figure out, how do you manage scattered site real estate? How do you provide service to the residents? How do you provide repairs to the home? How do you administer the revenues off of a business? I mean, we talk about these big numbers all the time, but we manage over 50,000 small businesses, and they're really small businesses. These are businesses with $25,000 a year in potential revenue, and about $10,000 a year of expenses that come in increments of $300 and $400 and $500. So just the whole back office administration, this thing was a big challenge. In
Amherst today, it's now 40 something thousand homes.
I think all in all, it's 50 something thousand. I don't know. It's got to be about $16, $18 billion worth of homes. It's not that many, really. I mean, if you think about the scale of the millions of families that need access to a single family home and can't get a mortgage, particularly today. Like we built the business to serve people that weren't going to get a mortgage because their FICO score was too low.
And so who is your renter?
So the renter, they're hard to fit in one demographic bucket. I would say that what's clear is that they're not the same demographics as multifamily because they have more kids and they have slightly more income than multifamily residents. And they're a little bit younger. They're not the same as single family home buyers because their credit score is a little lower, right? So the credit score is going to go up as you go. However, they have the same number of kids as people that live in single family homes. They're a little less married, right? So there's more single adults living with kids living in our homes than there are in the for sale market. They span a wide age group because what I like to point out is like the people there's clearly two camps of people. There's people that choose to rent and the people that don't have a choice, right? Like buying isn't an option for some. And some people, they don't want to buy because they're not committed to the location, right? So like you move to a new town, you check it out. So there's always been this robust rental market for those two populations. We built the business for the people whose FICO score was too low to get a mortgage because we thought that they were good customers. And we thought the mortgage market was making a mistake by leaving them out. So you can have a low FICO score no matter your age, no matter your gender, no matter your race, no matter your family size. A low FICO score can happen to you in less than 2 months. So what's consistent is that their credit score is in the low 600s.
So they're not ready to buy today.
It's not even a ready thing. It's like it's the way that credit is allocated in the United States for homeowners. It just isn't fair, and it's not fair after Dodd Frank. I lobbied hard against Dodd Frank and lost. So it's people that may have been a homeowner and had a minor economic setback, and their credit score fell below. When they sell, they can't rebuy.
What are your thoughts on the narrative that some of the tightening of credit potentially deepened the crash and deepened the single family construction bust and caused less construction in, let's say, 12, 13, 14, even as the market started to come back a bit?
I think it's not even a narrative. I think it's just true. See, I'll do you one even worse. The retraction in availability of credit created too many apartments because apartments had funding. You had Freddie Mac and Fannie Mae with their mortgage guarantee programs for apartments, so that if a developer were to go through all the trouble to get a permit and design and build those residences and lease them up, they knew there was a takeout, right? They knew there were people to live there, and they knew that there was long-term financing available. Go back to 2000, from 2009 till 2016, probably, there was no takeout for these homes. So there was if there's not a consumer that's going to go get a mortgage and buy the home from the builder can't build it.
And so when you look at like the demographics of the country, there's been this shift in delays, right? People go to school longer. They get married later.
Longevity.
Right? They have kids later. They buy a home later. Do you think that occurring, and if it continues to occur, is creating a bigger appetite for single family rentals? Like that period when somebody's like no longer in that period where they're going to be in an apartment, right?
That's right.
But they're not ready to buy a home yet.
You're right.
But they want more space.
Yeah, I think there's two things creating demand for it. One is that even when they're in that phase of life where an apartment serves your needs, right, is narrowing because of work from home. Like you'll see people that used to have a studio apartment, they spent all day at work. And now they spend 2 or 3 days of work. We talk about 2 or 3 days of work at home. So now they have a 1 bedroom or a 2 bedroom, right? So you're seeing this whole product demand shift create this larger demand as well. We study this a lot. Like I think people don't, I talk about this in a few different places, but I like to use my family as an example. So my dad last week turned 88. And when he was born, his life expectancy was 63 years. My son was born, so my dad was born in 1937. My son was born in 2003. When my son was born, his life expectancy was 84 years. So in really one generation, from my dad to his grandson, right? I guess 2 generations, life expectancy went up 20 years. Okay, that's a third. If you look at changes in life expectancy for the previous 100,000 years, it's not a third. So economy-wide, we're not all prepared for what changes in longevity are doing to changes in consumer behavior, but housing is one of them. And so what does that mean in housing? It means that the people born in 1937 are still in a house, right? That 20 years ago wouldn't have been, right? The thought was they wouldn't have been there. So the population consumes more housing because they get to live longer. The second is that if you kind of follow the model that I think we're all raised with, I'm older than you are, but the model I was raised with is you're sort of out of your parents' house. Maybe you're in college. Maybe you have like a first job apartment kind of thing. And then you're married and having kids. And that married and having kids is in your 20s, right? Mm-hmm. Well, that if you're going to live to be 63, being married with kids at 25 makes all the sense in the world. I mean, my dad and my mom were having kids when they were 19, which makes sense. They were a third of the way through their life. Well, it also makes sense that to do that at 30 now may make more sense if you're a third of the way through your life when you're 30. So all of those life milestones, marriage, children are moving forward, which I think is just the beautiful thing of medical science and health and knowledge and everyone taking better care for themselves. In terms of like specifics to our industry, what it's doing to demand is, I think, a second piece, which is not only do they need more space, and they have this period of time between your parents' house and living with your spouse is widening, so it creates this demand. We talked about the amount of space they need has gone up, and now we've hit them with, oh, by the way, the house you would like to move into is still being used by previous generations. And oh, by the way, unless you meet this very narrow credit perspective, we're not going to finance you to buy that house anyway. So all of those things are massive demand creators for someone that needs the product, the space, the location, all the things a single family home offers you, and isn't in a position to buy.
And so when you look at a housing affordability, when accounting for U.S. incomes, for mortgage rates, and for U.S. home prices, on a national level, we're at multi-decade lows for affordability.
They're more expensive now than they were in 2006.
And so if you were the housing czar, if you could do whatever you wanted, what are the things that you would do potentially to improve housing affordability? Or would you not? Would you just say
the first thing
the
I would
market
do
needs
is,
time?
I don't have all the answers for sure. We get asked this question a lot by governors, by people in the federal government. And tell them what we do know. We don't know the answer, right? We know that the mortgage market doesn't take enough credit risk. And we know that the credit risk appetite comes with some pretty nasty things you have to say and do. And so we don't think the government's going to do it. So what I mean by that is right now the market literally takes almost no credit risk. The mortgages that get generated today have the same origination costs. They have higher guarantee fees than they did pre-crisis. And they're only made to people who have an incredibly low default risk, even if home prices were to fall. So there's just no credit risk being taken by the market. The keys to taking more credit risk, unfortunately, are lowering your losses when something bad happens. And where do losses come from when a mortgage defaults, right? They come from the amount of legal entanglement you have to enforce the note, the foreclosure process, and they come from the amount of time it takes. So when you sit down with an elected official and they say, I need to make homes more affordable, and I say, well, just make more mortgages to a broader group of customers, they're like, oh my God, that almost killed us all in the financial crisis. They had defaults, and we have to walk them through. A lot of that was fraud. A lot of that wasn't just making loans to lower FICO people.
And so do you think there was a panic back then?
And we're still suffering from it.
Yeah.
Yeah. It was the pendulum swung
pulling
too
the rug,
far.
pulling too many people out of the
way too
market.
many people. I mean, our average family is making $100,000 a year, and their rents are $25,000 a year. Our losses are 1.5%.
And so is the idea there, if you were to open up more of the credit, that some of the people at the bottom of the market could enter and builders would satisfy that demand and build more at that segment of the market?
That's right. Yeah, builders will build what they can sell. And you can't sell. The problem with selling a $300,000 house, it's hard to build a $300,000 house. We do it. We build houses both the old fashioned way, and then we have the modular home business. It's hard to build a house you can sell for $300,000, which is kind of, with rates where they are, it's kind of where you need to be, but you can do it. But if the market to buy it is tiny because no one can get a mortgage, it doesn't matter.
And without doing that, if you don't, increase that credit to that segment of the market, is, just some time, will that allow affordability to restore a little bit?
That's kind of what we think is going to happen. Yeah. But, and we're spending a lot of time on this today at the shop, we think that this is a decade.
So it's a decade of home prices going up less than incomes and maybe a little bit less than inflation.
The cost of housing going up a little bit less than the incomes.
Yeah.
Right.
And does mortgage rates coming down a bit more?
Yeah, mortgage rates are interesting. So real rates are probably 100 basis points too high. So the 10-year swap rate is probably 100 basis points too high given the actual outlook for inflation. Remembering that the hundreds of billions of dollars invested in AI is all deflationary. So it's a little hard to argue. I don't know why we have interest rates so high, but that's a different story. So I would say that the benchmark rate is about 100 basis points too high. And then the thing that we like to point out to people when they listen to us is that we impaired the mortgage market by taking Freddie Mac, Fannie Mae, and the primary dealers out of the investor base. So those three balance sheets, the primary dealers that were market makers and speculators in the asset class, Freddie Mac and Fannie Mae owned 1/3 of all mortgages. And the benefit of that is it kept mortgage interest rates highly correlated to the risk-free rate. The Fed came in and basically bought all those mortgages up. And so they became about 1/3, but then they stopped really investing. So now you have this impaired asset that lost its investor base. So just yields on mortgage-backed securities are probably a half to maybe in some times a point too wide relative to the risk-free rate. So you have maybe almost 2 points of your mortgage rate. So the difference between 5 and 7 is because interest rates are too high relative to the economy and because mortgages lost their sponsorship base. So you can fix those things with just a little bit of effort at the federal policy level.
Do you think the Fed regrets their purchasing level of mortgage-backed securities in 2021?
I don't know. Whenever I meet with them, they don't express a lot of regret. They're pretty smart guys. They gotta know what they're doing. I think in the end, we're going to find two things. Our view is when the book is written, it's going to be that this last rate hike was too fast. Well, it's a couple things. Rates were kept too low for too long, and because they were left for too low for too long, they had to basically slam on the brakes. And when they slammed on the brakes, they slammed on them too hard, and they left them too long. And so I think just this volatility is a response to a bad policy of keeping rates too low for too long. We had negative real rates all through COVID. It's one thing to be accommodative. It's another thing to just give money away.
Yeah. And so the home builders the past few years have been fairly resilient in 23, 24. Mm-hmm. They really hit the sweet spot with the forward commitments, with the mortgage rate buy downs.
Yep.
That seemed to really entice buyers into the market. But this year they've kind of been a little choppier, right? Demand
is suffering.
And so what's your short-term outlook for the builders? And
we don't invest in builder stocks. We've looked at a bunch of them. They're very difficult. They're businesses that are so rate dependent, and they're dependent on really short-term things that are hard to predict. I would say the nation doesn't have enough housing. If you build houses over time, it'd be fine. But we're all seeing I think the housing market in general, the rental market and the for sale market has just seen a cooling off of some pretty dramatic demand. And so the simple math is that if you look at how many homes they built and sold, they probably sold some of the 2028 demand in 2025 or in 2023 and 2022. The car manufacturers did this once where they pulled forward all the demand and then they paid for it. I think that's probably what you would argue is that you're not building homeowners as fast as you need to sort of soak up that supply. But we also like to point out that as we said before, the new house market, it's a different asset, right? So our portfolio is in kind of, I would say between the first loop and the second loop of all the major cities in the South. So in Charlotte or in Atlanta or in Houston and Dallas, we're not in the first loop. That's kind of like the urban core, but we're between that one and the second loop. If you're in the neighborhoods that we've built, we built a neighborhood in Phoenix that I think is almost in California. The thing's way out there. And so it's just a different customer. It's a different product and the market demand just can not be very deep.
Yeah. And so in this period of more strained affordability, we've seen a lot of politicians and legislators go after different groups within the housing sector. So we've seen in some communities them going after Airbnb rentals. We've seen on a national level going after realtors. We just saw recently some comments that the government wants builders to stop, hoarding their lots and build more.
Build, baby, build,
even though they're in this market where, like we've talked about, it's shifted. And we've also seen them, go after some of the single family operators. What's kind of like your take there?
Well, on who to blame?
Well, on just like what's going on in the market and
I think we sit down. So, we're lucky. We get consulted by governors, by senior people in the federal government. Everyone kind of wants the playbook. Tell me what to do and I'll fix it. And we tell them to make more subprime mortgages, and they tend to fold up their notebooks and head on. But I think that it's easy. People are frustrated, right? People are super frustrated because you have this expectation that I'm this. I did all these things, and now I should be able to buy a house, and I can't. And you want to blame somebody, right? And if you see me buying it, you're like, well, it must be his fault. So I get it. I think it's dangerous. I think that when this young man killed the CEO from the healthcare company, his manifesto was to kill someone in housing or someone in healthcare. Right? So I think that when politicians, to get a couple of cheap lines or a couple of clicks, or to get the sort of admiration of the people that really don't understand what's going on, feed this stuff, then they make enemies out of people. They make enemies out of Blackstone, or they make enemies out of Amherst, or they make enemies out of the United Healthcare. So one thing we tell people is that we need more grown-ups in politics, and they need to think about what they're saying and how that's heard by people. The argument that the home builders are not hoarding. The home builders are they're in the move-in business, not the storage business, as they say. They will build every house that they can sell. And they usually build two more than they can sell, right? So they're not hoarding anything. They don't have demand, and they don't have demand because their customers don't have financing, and they don't have financing because the mortgage market doesn't take credit risk. Like, that's as close as you can get to the core of the problem. So what we provide is a solution today. So a family, and I grew up this way, a family has, kids in school. They're not thinking about the 10-year treasury and the HPA. You got kids, you know what they're thinking about, right? How do I protect my kids? How do I give them the best opportunity? And what do my parents think about? How do I put my kids in the best schools? And best meaning no metal detectors, right? Yeah. Like safe, well-funded, so that they have the right educators, the right tools. Do that? I had computers in 1983. People didn't have computers. So where can my kids get the best chance to improve themselves, be safe, get a good education? And that's the shot. When we talk to consumers about what's your priority in housing, it's education, safety, in that order. So what we provide is a way for someone to achieve those things today. And I sat with the Federal Reserve. I sat with the governors themselves. I sat with Chairman Bernanke. I sat with Secretary Yellen, and I begged them to try to get in the way of Dodd Frank because I knew what was going to happen. And when we lost that, I said, okay, well, we're going to get these families in these houses some way. And we have a lease, and we have financing. We can operate the real estate. So let's get the people in the homes and get their kids in the schools, and then let all the wizards figure out like what's the better solution, because today there isn't one. Until someone with a 625 FICO can go borrow money at about the same rate that you and I can borrow at, there isn't a better solution. And so that's, if you want to blame somebody, it's the knee-jerk, explainable, but too long in place reaction to the subprime mortgage crisis.
And if they were to go after the bigger single family operators, could it potentially backfire? I mean, you look at some of the new construction the past 5 years, some of that marginal increase is from some of the institutional groups adding some of the supply
Chairman
to the market.
Bernanke put it well when we met with him. I of course met with him in 2010 or something. But what they saw right away was that, wait a minute, you might be a shock absorber to the housing market. So that when in 2009, when the consumer wasn't available to buy the house, and I wasn't there to buy the house, there was no one left to buy the house. And we spent a lot of time with the government saying, guys, like, hold on here, stop. I mean, one of the backstories is when we first started this business, we had a handshake to buy 50,000 houses from Fannie Mae in one trade. And our argument was, even if you sell them to us at the wrong price, they never hit the tape and they never become comps, because they were selling homes at distressed prices. The distressed price becomes the comp. Remember back to, at some LTV, everybody defaults. So all the houses around them, the LTVs get marked up, and you create another wave of defaults. And we spent a lot of time trying to warn people that the first wave of defaults were mortgages that no one should have made. The second wave of defaults were people that were suffering from a retraction in the housing market. The wave of defaults that we're about to see were the defaults that were triggered by lower home prices. And that's the proverbial drain. And so we spent a bunch of time saying, stop selling houses and either sell them to us. And so I think that if you stand back from an academic perspective, the single family operators are a shock absorber to the housing market because they create an ability for someone to live in the house that doesn't have to buy the house. In terms of, do we compete with people? When I buy a house, yes, someone else didn't get to buy it. But when I buy a house, someone gets to live in that house that otherwise couldn't get to live in that house. So I think if we take a step back and say, okay, do I just want to exclude this business because, like, Fat Sean's private equity is easy to hate? That's great, but I got 50,000 families that don't have another chance to live in a modern suburb without someone else owning the home. So until someone has a better solution for those families, we're going to keep fighting for them and say, like, we are the only solution.
And so when you look out at the housing market, even some of the markets where active inventory has climbed a bit, Texas, Florida.
Back to pre-COVID levels in many cases, right?
And even in those places, there's still a missing amount of churn in the resale market, right? Yeah. And you were one of the people, one of the best that I talked to back when mortgage rates had shot up, predicting that not only would there be a pullback in new listings for a period, but really a sustained period of, some of that churn being gone with switching costs being so high, going from, that lower monthly payment, lower rate to a higher monthly payment, a higher rate, and that would be around for a while. Heading forward, do you think that is slowly going to ease up a bit? Is it going to take time for it to ease up? Do incomes have to rise? Do rates have to come down a bit more? What's going to happen there?
It's interesting. We're studying this pretty closely now because the supply has been rebuilding, and we have enough data to figure out who's selling, like who's listing, who's selling. People with giant gains are selling more often than people that bought recently. So we think there's a little bit of like, take your money and run going on. But yeah, I think the overall message is that we're on the lookout for something that changes the velocity of this whole thing, and can't find it. We spent a lot of time on the Airbnb guys. I thought those guys might be the weak hands because at the end of the day, it's like, who has to sell?
Yeah.
And we have a pretty good model on how supply affects home prices. But even when you just radically change supply, it moves home prices in single digits, right? So we think that it's important. If people want to hate single family rental, great. Come to the market, to the table with a better idea. But now's the time because we think you're looking at a decade of difficulties for people to get into buying a home.
And so if we had stayed on the 2019 trajectory for existing home sales, and that was a pretty normal level when you adjusted for population, household around 5.3 million. If we had sustained that level, by the end of the year, there would have been 3 million more existing home sales in that environment.
It's crazy, right?
Versus this one. And that includes
us done to real estate agents and loan origination platforms.
And that includes us going 1.2 million above trend through like spring 2022. And then not only erasing all of that, but then falling that far below. When do you think we'll get back to kind of normalish levels of turnover for existing home sales?
It's a function of rates, right? It's like I said, the switch costs are too high. Just how we model when someone will go ahead and refinance their mortgage based on, because there's frictions to refinance your mortgage, right? It's not free. When someone will default on their mortgage because it's like they're too far underwater. The same thing can be said for when will people finally pull the trigger on a sale. They'll do it at an inverted rate. Like they'll pay off a 5% mortgage and get a 6% mortgage. But when that rate is inverted by right now it's almost $1,000 a month. It's just too much. The friction is just too high. So I hate to dodge the question, but it's a matter of when do basically incomes either catch up, which is I think what has to happen, or rates need to tail back down to a 3 handle.
And so as incomes rise, some of that switching cost comes down, right?
Some of the switching cost comes down, and in the nominal terms, it goes down, right? I mean, the nominal can stay the same, but the effective cost of it goes down.
Like as a share of their discretionary income, it would go down as their incomes are rising.
That's right. So that's why we think we're talking about really a next decade of a lot of demand for rental, because it's the choice of how do I get the size, how do I get the the features that come with that home, like the school location, whatever. And that's how long we think it's going to take for what we would see as sort of long-term depth of the standards for affordability to be recaptured, because we think it has to come from income growth. Yeah. And that's staring in the face of all this in AI, which people are arguing might drive incomes down, not up.
And according to John Burns, back in Q2 2022, institutional operators, those with at least 1,000 homes in their portfolio, made up 2.2% of all transactions that quarter. Mm-hmm. Recent quarters, it's been way down. Yeah. It's like 0.2. Yeah. So it's like, what is that? 1 out of 500-ish?
Yeah,
it's
out of
pretty
500.
low right now.
Exactly.
Yeah. And a number of the bigger operaters are net selling, not like huge net selling.
Just kind of trimming and cleaning up.
And so what would it take to kind of get single family rental transactions going again?
I think for the wave of investing that took place to a certain extent was kind of your first wave of investors that were a little bit more adventurous, right? So you look at most of the money that was put into the space, it was private equity guys. Private equity guys have a very high cost capital, right? It wasn't that much core. So we really think the answer to that question comes in this investor adoption question, right? Will state pension funds allocate and scale to single family rental? Because 2 years ago, it was like 1 minus ESG, right? Supporting me was like the opposite of being responsible in your ESG program. Even though we argued like we're probably the most ESG thing you can do because you're providing the opportunity to the families otherwise can't have it. The narrative was so negative that those pension boards wouldn't invest. I think that the time that we've had to operate the real estate has also made that core investor group aware that you can collect rents, you can provide good service, you can operate this as a piece of real estate. That tracker is helpful, but the next wave of investing won't come from the same sources of capital. It'll come from those core investors finally saying, you know what, a 5 or 6% cash on cash return that outpaces inflation by 50+% every year has a spot in my portfolio and scale. And that's who we spend our time with. And we see that we have those investors that are 15, 20-year investors. But I think that the nominal returns relative to fixed income yields hurt capital flows into the space quite a bit because of where the money was coming from, the kinds of investors that were investing. I think the flows into real estate in general went down because of the office crisis, had everyone sort of trying to measure what their real exposure was. Those are kind of both behind us. And the next wave is just going to come from people that say, is it 60% equities, 40% bonds, or is it maybe it's 30% bonds and 10% real estate?
And do we need to see on a real basis prices come down more? Do we need to see incomes rise more? Construction cost flatline more?
I think that the returns we have a fair value model that says where is a portfolio supposed to be relative to the S&P 500 versus the fixed income markets, whatever. They're not overpriced at all. Like home prices on a free cash flow basis are not overpriced relative to other investments. They're overpriced relative to like this consumer affordability thing, which is the one thing that has everyone kind of scratch their heads. But an investor can make perfect sense of, like I said, an asset. You can buy assets today at sort of a 5.5% cash on cash return. And over a decade, you really can't find a decade, even starting in 2006, that home prices didn't beat inflation by about 50%. So if you think about an inflation protected treasury bond earns like inflation plus 1 or 1.5. These things yield inflation plus like 7, 6 or 7. So we don't think it's a return. We think it's investor acceptance.
And before we wrap up, one last question. What, if anything, when it comes to the U.S. housing market, keeps you up at night?
Well, this affordability thing is a concern. We keep an eye on, like, is there going to be a sharp increase in sellers? Where would it come from? So like I said, we did a lot of work on the Airbnb guys because they own $2 million or something, which is kind of interesting, is that the single family guys like us got bludgeoned by a bunch of people for competing with homeowners. When we buy a home, it goes back into the market to be a place to live. These guys buy a home and it turns into a hotel room. And we bought, collectively, our whole industry bought 300,000 of them. I think they bought 2.5 million of them or something, 3 million of them. So it's kind of this weird thing. But they're very low levered. Their revenues are good. They had a little downturn, I think, mid last year, but so we don't think they're going to see distress selling there. So I think that's what we look for is I guess there's someone that's going to have a rash of mortgage defaults or
weekends,
whatever weekends. And so because if you tried to put another 3 or 4 million units through the market today, you drive home prices down.
Yeah. Well, Sean, thank you so much for making the time to speak. And you're going to be at Resi Day.
I'm looking forward to it.
2025 on Friday, November 7th, speaking.
I'll have nothing left to say.
Well, thank you for making the time to chat.
Thank you.